Imagine you are standing in line in a bank, and you see a man carrying boxes of cash, holding the deposit slip with his teeth. Drug smugglers were carrying so much cash that they literally tore the handles off suitcases trying to carry it. One Federal Reserve branch in Miami had more cash than every other federal branch in the country combined. So, how much cash was getting deposited into South Florida banks? In 1978, Florida had just 10 banks chartered for international banking. By 1982, there were 44 banks. That's 340% in just 4 years, because there was so much cash that was flooding in. While the banks, everywhere else in the country, had a cash deficit, banks in Florida had a $55 billion surplus. The banks were required to file a CTR, currency transaction report, for any cash transaction over $10,000 to the IRS. At the time, this wasn't a law against money laundering because money laundering itself wasn't a federal crime yet. In 1979, federal agents launched Operation Greenback. Investigators didn't chase kilos, they chased deposit slips. Because the focus of the operation wasn't mainly about the drugs, it was about the money. Great American Bank of Dade County became the first bank to fall. In just 1 year, between January 1980 and February 1981, 3 bank employees processed 406 separate cash transactions, totaling around $94 to $96 million, without filing a single currency transaction report. In 1984, the bank pleaded guilty to 4 felony counts of failing to file CTRs. Think about that for a second. Guilty of failing to file a report. The employees lost their jobs, and the bank was fined up to $500,000. That's $500,000 for laundering $96 million, approximately 0.52%. Let me ask you something. If you ran a bank in 1981, would that fine actually deter you? So, this is the lesson today. Operation Greenback and the Great American Bank case exposed a loophole that banks could be fined for sloppy paperwork, but nobody could be prosecuted for money laundering itself because it wasn't yet a standalone federal offense. Money laundering had already been going on for years before the Money Laundering Control Act of 1986, when it became a distinct federal felony with real prison time. Prosecutors could go after the bankers personally, not just the institution. The cost of looking the other way became too high. Drug traffickers had to get far more creative, smurfing small deposits across many accounts, buying real estate, and eventually moving operations offshore, because the easy version, walking into a Miami bank with a gym bag of 20s, stopped working. One thing to note is that only one bank was indicted in Operation Greenback. The operation was aimed at forcing bank compliance, and investigators didn't have the kind of proof needed to criminally charge an entire bank. One investigator said the strategy was to get the banks to comply with the law. Prosecutors had an easier time proving cases against individual launderers and specific transactions than against an entire bank as a criminal enterprise. Operation Greenback focused on the financial choke point, rather than trying to indict every institution touched by cartel cash. Therefore, the aim was to break the laundering pipeline, not to shutter the whole banking sector.